Good afternoon and welcome to an overview of the last 90 days of real estate as we see it here in South Central Pennsylvania. On today's program we have two gentlemen. The first, seated to my immediate right, is John Finley, the CFO of Greystone Tower Bank. Seated to John's right is Jeff Thomas, the Senior Regional Director for First Industrial Realty Trust, both of which are based here in the Harrisburg market. I'll be the moderator for this brief discussion on two segments of the real estate market that affect all of us, at least in some way. My name is Bill Gladstone, and I am with the Bill Gladstone Group of NAI CIR. We are a commercial and industrial real estate company also based in Harrisburg. Gentlemen, welcome to the program, and thank you for being willing to share your information with us today. And with that, we'll jump into the program immediately with the first question going to John. John, the Labor Department has released employment data in the beginning of this month. What are you seeing in this data, and does it seem as though the country is moving in the right direction with respect to employment gains?
Well, Bill, there was a lot of enthusiasm about this last report, and I think partly because we want to be enthusiastic about jobs in our country. It was positive that this was the first time since 2007 that the economy posted back-to-back gains of jobs in the private sector, over 200,000 jobs. The unemployment rate dropped to 8.8%. By historical means, still very high, but again, moving in the right direction. The things that concern a number of us about the jobs report is that there appears to be a segment of the unemployed that continue to be unemployed for an extended period of time. And to some extent, that represents structural unemployment, meaning that there's a mismatch between the skill sets that they may have had, perhaps from the auto industry, housing, maybe mortgage banking, versus the needs of the economy right now, where those skills may not be needed at the prices that the market was paying pre-crisis. I think the other thing that's concerning is that the improvements are happening in the market during a time when the Federal Reserve Bank is extraordinarily accommodative with respect to interest rates and other tools to spur the economy. And the question remains, can the economy continue to grow without such support? There is concern, obviously, about the deficit. Congress and the administration need to address this. The Standard & Poor's recently put the federal government on a negative watch. And so obviously, as taxes are raised or as spending is cut, those are drags on the economy. But I think overall, there's a degree of optimism that came out with this report.
Very good. Thank you, John. And Jeff, question for you. What do you see in the current state of the market in terms of vacancy, net absorption, rates, concessions, and how does this relate to other markets similar to ours?
Sure. The central Pennsylvania industrial market continues to show signs of improvement. Consumer spending has ticked up some. New corporate investment for to support consolidations has improved, as well as the trade volumes that we've been hearing about over the last several months now. So as a result, central Pennsylvania industrial market closed the quarter at 11.5% vacancy, which is an improvement from the prior quarter. The net absorption tallied to 1.4 million square feet. New construction continues though to be dormant, which has only helped the overall industrial market stats and the tightening of the market that we've seen. Lease rates continue to remain stable while still under some pressure, but they have stabilized. They're certainly not dropping anymore like we saw 12, 24 months ago. Class A rates typically have been in the range of $350 a square foot, plus or minus there, depending on what all would go into a building. Class B rates are still, probably under further pressure mainly we're seeing those be sub $3.
Very good. And John, back to you. Why is the private sector employment such a focus, and what does that mean for our local marketplace?
Well, Bill, I think a couple things are important to keep in mind. One is that the Commonwealth of Pennsylvania has fared better than many parts of the country. But I think as you look at a chart that shows unemployment rates from 2001 to the current, you begin to see just how significant the unemployment rate is. That being said, South Central Pennsylvania tends to fare better than the rest of the Commonwealth as well. The Wall Street Journal reported recently that 70% of employment is in the private sector. Private sector employment combined with consumer spending has tended to drive our economy. And to the extent that employment is still weak from historical standards and the consumer is not able to buy goods and services as they were before, we're moving in the right direction, but not out of the woods by any means. I think there are a couple of wild cards for us to consider. One right now is commodity prices, particularly gas and oil prices. The concern is that these cost increases may not be temporary in nature, and obviously that would be challenging for the economy. I think, as Jeff pointed out, there seems to be a turning towards a cautious optimism. And I think that bodes well for us relative to where we were a couple of years ago. But again, I think we all would love to see that exuberant growth, and we're just not there yet.
Thank you, John. And Jeff, last question back to you, and maybe John, when Jeff's finished, you want to comment on this as it relates to jobs. When you were talking about the concessions, the rates, net absorption, how does this compare to the fourth quarter of 2010? And what trends do you see, especially with the jobs coming up on that one, John? What trends do you see, Jeff, for the second quarter of 2011?
Sure, Bill. As far as the change, quarter over quarter, the vacancy rate has improved 90 basis points, from about 12.4% down to the 11.5%. The net absorption figure of 1.4 million square feet, for the first quarter of 2011 compares to a total of 2 million square feet for all of 2010. Concessions, as lease rates have stabilized, concessions have started to pull back some. Certainly not experiencing having to give out as much free rent or relocation allowances or discretionary improvement allowances that were very common 12 months, 24 months ago. As far as the outlook going forward, I think we'll continue to see consolidations here in the market. The central Pennsylvania market, with its location, regional infrastructure, the highway network, the intermodal facilities, the parcel hubs, we just attract the large distribution centers that where companies are looking to, if their revenues are staying pretty much consistent, they're looking to affect their bottom line by squeezing the expense side through consolidation. So I think, going forward, we'll see new construction start again, certainly before the year's out.
Very good. John?
Well, again, I think what Jeff's saying is that there are a lot of businesses that want to get enthusiastic about moving forward. I think there tends to be a fair amount of risk aversion yet in the market, and I think that's why we see some of the tendency that exists out there. I think a lot of people are still pretty concerned about what's happening with respect to government regulation, taxation, and so to the extent that there's caution out there, if we can eliminate or mitigate some of those risks, I think the private sector wants to come back in a big way, and so we just have to give it some time.
Thank you, John. And both of you, thank you very much for sharing your information with the viewing audience today. And to the viewing audience, thank you for tuning in to our segment this time of the last 90 days. And we look forward to seeing you again in 90 days in the next section of the last 90 days. Thank you. Thank you.